And Rebecca, let's just start off, I guess, with what is, for a lot of people, the elephant in the room. $60 a barrel on Russian oil at a cost of production that for Russia is well below that. Does this actually have any real impact at all on prices?
So the near-term answer is no. $60 cap is above where Urals are currently trading. That's Russia's benchmark crude. So this is not punitive to Russia. They can very easily say price caps are irrelevant, business as usual, and keep selling at a price that falls, underneath that cap and take advantage of Western insurance and shipping. Now, there does remain to be seen if Russia does respond that way. They have been very vocal in saying, we will not participate in a cap regardless of price. The EU tried to set a price just at that perfect level so that they may actually get on board. But they have another grade of crude called ESPO, which is trading above the cap. So it's not a sure thing that they don't retaliate. But for now, the market is A, reducing the risk that they do retaliate based on that price, and B, and this is important, fairly confident that Russia has amassed enough of a shadow fleet that in the event they do decide to not participate in the cap, they have enough vessels to carry that crude to India and China on their own.
Well, just curious, though, are those Russia's own vessels, or are they actually leasing out from other nations, basically using other nations' vessels as a cover?
Both. So they've been very active buying vessels, used vessels, old vessels, vessels that were set to go to scrap. They're also leasing other vessels. They're also going to utilize some of the fleet that's available from China and India, who have been pretty, on board with continuing to buy Russian crude. They've figured out ways to provide insurance. So they've been working behind the scenes to prepare themselves for this retaliation event. It's not necessarily a sure thing, but the market is reading it this way. Okay, the price is good enough, lowering the chance of retaliation. If we get retaliation, we don't think there's this massive disruption to crude oil flows.
I feel like $60 price cap is something that people had speculated on and were pretty much anticipating. Does this move the market? And if not, what would move oil out of its range?
So this doesn't move the market is the bottom line, limited disruption near term. What would move the market is going to be all centered around China demand, this reopening trade. You talked about in your lead-in the volatility we saw this week. We came in on Monday, crude was down, testing 2022 lows. We've rallied over 10% off of that on the fact that China has softened some of the language around its zero COVID policy. That demand engine is really what drives crude higher out of this current range. The second catalyst that's going to be a factor comes in February when Russian products go under sanction, and that actually could create a disruption for supply. However, that's a ways out from here, and most traders see a lot of volatility, a lot of chop, but staying within this range, 75, 90 into year end, just on the fact that we don't see a huge amount of disruption from these sanctions.
Okay, so let's talk about China for a moment here. If the China demand story is what's going to be the driver here for oil prices, for price action, can you quantify the demand that we might be looking at once China does drop the COVID zero stance and starts to bring its economy back online?
Yeah, so estimates right now look like zero COVID policy has sucked about 900,000 barrels of demand out of the market. So reopening would bring that back. It's not going to be immediate. It's going to be gradual. It'll happen in stages as the reopening occurs. But that's the kind of demand acceleration that many are looking for. That coupled with the fact that we don't have an SPR release and we may have a product export ban coming into play, have many analysts really seeing the upside potential in crude taking place in the end of the first quarter of 23 into the second quarter of 23.
Rebecca, I want to talk about, I guess, investor positioning. And there are a lot of folks out there, whether they're actually dedicated commodities traders or just cross-asset investors overall, who have, I think, made some relatively prescient bets so far this year. Heading into next year, given the increase in prices that we've seen and the come down that we've seen over the last couple of months, is there still a volatility argument that could be made for staying invested in this? And more importantly, is there a price argument to be made as well?
So let me unpack that a little bit. There's definitely an argument to be invested in commodities. I think you're highlighting as something that's very important. The volatility that's taken place over the course of the year, the policy uncertainty, the headline fatigue has certainly made it a lot more difficult to kind of jump on board with that trade and has scared some people off. I think the structural deficit of supply, the accelerating demand story out of China is a very compelling thesis for many, but I think the way it's going to play out is going to be this kind of slower, okay, let's wait and see for the data. Maybe I missed the first 5-10%. I'm going to wait and see and wait for clarity before I get involved. I'm not going to be the first guy in, and I'm not going to get chopped up. So it means the trade is just going to be a little slower to gather steam, but I certainly think investors are doing it. They're focused on it, and they're going to put money to work there.
Right.
I think we're looking for clarity.
Rebecca, final question to you, and very quickly here. OPEC Plus next week meeting. What do you expect from that could move oil prices?
So I think over the weekend, they're probably going to just roll over the existing cuts. What could move markets, though, is if they're very, very vigilant in their commentary around we will act if demand is not strong at the end of the quarter. We are going to continue to support this market. That will reassure the market that even though they didn't act right now, they're ready to act if China doesn't come back as quickly as some hope.